Hi friends, the Finance Bill 2022 proposes a lot of amendments in relation to charitable trust claiming exemption under section 11 and in relation to institutions claiming exemption under subclauses 4, 5, 6 and 6A of section 1023C. It is of course true that many of these amendments are just for the purpose of bringing exemption under both of these regimes at par. Today we are highlighting some of the important amendments relating to charitable trust and exempt institutions. The Finance Bill 2022 proposes that if a temple, mosque, church, gurdwara, etc., which are notified for the purposes of section 80G2B receives voluntary contribution for the purpose of repairs and renovation, then it can be treated as corpus donation and exemption can be claimed on such part of contribution. It is, however, true that there are certain conditions which are required to be fulfilled to claim such contribution as corpus donation. These conditions are that such corpus fund has to be separately maintained and it has to be utilized only for the purposes for which contribution is given. Such fund is required to be kept invested in the modes specified in section 11.5. And further, such funds cannot be utilized to give it as a donation or contribution to any other person. As we know, the trust and institutions are required to apply 85% of its income in order to avail exemption. The Finance Bill 2022 clarifies that any sum payable by such trust or institution shall be considered as application in the previous year in which it is actually paid, irrespective of the previous year in which such liability was incurred by the trust or institutions as per the method of accounting followed by it. Presently, it is not specifically provided that trusts and institutions claiming exemption under section 11 and 1023C are required to maintain books of accounts. However, audit provisions are there. But now Finance Bill 2022 provides that these trusts and institutions shall keep and maintain the books of accounts and documents in the prescribed form and manner. Presently, it is provided that exemption under section 11 shall not be available to a trust if it fails to furnish its return of income as per section 139(4)(a). But similar type of provision is not there under section 1023C. The Finance Bill 2022 provides similar provision under section 1023C, and therefore, if the institutions claiming exemption under section 1023C does not file its return as per section 139(4)(c), then no deduction can be claimed by such institutions. Presently, there is controversy as regards computation of chargeable income, where exemption under section 11 and under section 1023C is denied. It is observed that department tends to tax entire receipts of the charitable trust in such cases without allowing any deduction of the expenditure incurred for earning such income. Obviously, SSC claims all the expenditure incurred for earning such income. The Finance Bill now clarifies that while computing chargeable income, all the revenue expenditure which are incurred in India for the charitable purposes of the trust shall be allowed as deduction. However, there are certain conditions like such expenditure should not be by way of loan or borrowing, and it should not be in form of depreciation on the assets for which application has already been claimed when it is acquired. Further, Such expenditure should not be out of the corpus fund and it should not be given to the other person. A new section 115 BBI is also introduced by the Finance Bill 2022 for the purpose of clarifying the taxation under certain circumstances. According to this new section, tax shall be levied at the rate of 30% when total income of the trust includes certain specified incomes. Such specified income may include that part of income which has not been invested as per section 11.5 or such income which is applied for the benefit of the interested persons. The Finance Bill 2022 also proposes penalty provision where unreasonable benefits are provided to trustees or other specified persons. For this purpose, a new section 271 AAE is introduced, and as per this new section, 100% penalty shall be levied when it is first time noticed that unreasonable benefits are passed on to the interested persons. If it is noticed again, then penalty will be levied at the rate of 200%. That is the 200% of the amount applied for the benefit of the interested persons. Section 11.2 provides for accumulation of income. The income which could not be applied that can be accumulated as per section 11.2 and 100% exemption can be claimed. There are certain conditions specified under section 11.2. But similar conditions are not provided under section 1023C. The Finance Bill 2022 therefore proposes similar conditions under section 1023C also. Presently, it is provided that the income accumulated under section 11.2 cannot be utilized as per the specified under the specified period. Then such income shall be deemed to be the income of the next year. But now it is provided that if accumulated income could not be utilized till the period prescribed, then it will be treated as income of such last previous year. Under the present provision, such income can be accumulated maximum up to 5 years. It means if it could not be utilized up to 5 years, then it will be treated as income of the 6th year. But now it is provided that it will be treated as the income of the 5th year itself. There are certain other amendments also that we will discuss later on. Thanks.